This video will cover the audit of smaller entities and not-for-profit organisations, or NFPs. The aim is to identify how the audit would differ when reviewing the two entities' financial statements. Auditors must be capable of auditing the entity under review. Having experience in auditing a smaller entity or a not-for-profit organisation such as a charity is important. If they miss something important, they may issue an inappropriate opinion in the audit report at the end of the audit process. The ethical code states that one of the fundamental principles that should be followed is professional competence. This also enforces the importance of understanding the client and its industry. We are going to start by looking at the audit of a smaller entity. This entity may not even require a statutory audit in some countries. Smaller entities are given an exemption from audit in the UK, for example, but they may still request an audit if they feel it benefits them. The reasons for not requiring a statutory audit are: the shareholders are often the directors of the entity, operating and managing their own business, and so there is less concern about whether their investment is being looked after. They may have only a few members of staff. This makes the disruption of the auditors coming in more of a burden on the company. Audits are expensive. This cost may outweigh any benefits an audit would have for the company. Control systems may be limited. With fewer resources, the systems may be more straightforward and not requiring expert advice from the auditor. If a smaller entity requires an external audit, the auditors would ensure that they have the correct audit team in place with the experience needed to conduct the audit properly. An audit of this kind has advantages and disadvantages. Some advantages are that it can be relatively low audit risk. If a business operates in a straightforward field that is easily understood by the auditor, there will be fewer transactions and therefore more time to review the business more thoroughly. In some audits, it may even be more effective to test 100% of the transactions. The shareholders run the company. With direct control, the management will have full understanding and responsibility for the organisation and can assist the auditor effectively. They may be met with less resistance from management because of this. The systems will often be straightforward and easier to understand, and this makes the assessment of control systems and their reliability easier. Some disadvantages are: due to the direct control of the company by the shareholders, they are in a position to manipulate the figures in the financial statements or hide personal expenses. Simple systems can often be manual. This increases the risk of human error, which needs to be addressed by the auditor and identified. Due to limited staff, there may be a lack of segregation of duties. Having one staff member responsible for an entire control system can increase the risk of fraud. They may not be very formal in their communications. Documentation on systems may be limited. Minutes of board meetings may be non-existent. This limits the amount of written evidence the auditor can obtain from the client. To conclude, depending on the specifics of the small business, there may be elements of an audit that are far more straightforward than dealing with a larger organisation. There will possibly be less substantive testing. However, careful planning is still needed to assess the risks and review the control systems and any limitations, to identify whether fraud risk is high and decide how to approach the audit. Not-for-profit organisations include charities and public sector entities. The way these entities are structured and how to prepare their financial information will be significantly different to how a private sector entity would operate. It is even more important that specialised audit staff are involved in the audit process for this kind of entity. The key differences we would see with a not-for-profit organisation are: they are not driven by profits. Their objectives may vary, but as an example, it could be to provide a service and not to make money. They will not have shareholders. There will be no investors looking for a return on their money, and there will be no dividend payments. The format of the financial information being presented will also be different. For example, a charity would prepare a statement of financial activities, which is formatted differently to a statement of profit and loss, as they are not in operation to make a profit. Auditing not-for-profit organisations come with their own audit risks. An example of some of these are, as with smaller entities, their resources are restricted, and so there may be a lack of segregation of duties and simple systems not documented. This could increase the risk of fraud and error. These entities are controlled by trustees. They often work part-time, and they may not have the expertise or time to make good strategic decisions. Volunteers are used to keep costs down. They may lack skills and make mistakes, but also they may not stay long and then not be available to assist the auditor with explanations after the year end. Income may depend on external factors. Government grants may be needed, which may depend on criteria being met and changes in these criteria being made. Donations may also be relied upon, which may depend on the economic climate and their public profile. They may have very complex regulations to follow. These must be understood by the auditor to ensure they can assess whether they have been followed correctly, and this increases the risk of disclosure notes being inadequate. The going concern review is more difficult. As there is often reliance on donations and grants for income, external factors are very important in assessing the survival of the entity. Any sudden change in circumstances could affect the entity short term. The audit approach for this type of entity should include careful planning. The materiality percentage will be low to address the high risk. This will increase the amount of audit testing performed. A specialised audit team will be required. If controls are not deemed effective, pure substantive testing may be required. Analytical procedures will be useful. If control systems are limited, they will provide the auditor with evidence to assess whether further testing is necessary. And if there are any issues gathering the evidence needed to form an audit opinion, as always, the auditor may need to modify their audit report. I hope you found this video useful. Thank you for watching.